Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Vetri Subramaniam. Needs no introduction, really. Vetri, great having you. Thanks for joining in and a happy new year at the outset.
Thanks, Neeraj. Thanks for having me. Happy New Year to you and to all your viewers.
Thank you so much. Could it be a happy new year or would it be a year that could be tough because of relative valuations, geopolitics, rising rates, what have you?
Well, there's always some challenge or the other that the market has to deal with. I wouldn't treat that as being good or bad. If the only definition of a happy year is an up year in the stock market, then I think that's a less than holistic approach to life in general.
No, but okay. So I was not talking about life. I was really talking about whether it's a happy new year for the markets at large or could it be a difficult one?
Yeah, I think it will be a little bit of a tricky year. Look, where I'm coming from is I think a lot of the good news is reasonably well known, Neeraj. We used to talk about the twin balance sheet problem. A lot of that is behind us. We look at corporate profitability. This is the best that I have seen for the Nifty 50 going back almost a decade in terms of ROEs. Free cash flow generation is strong, so on and so forth. But the challenge is really with the question you have to ask yourself when you look at the valuations, which are at the slighter richer end of the spectrum, is all of this good news actually already in the price? And that's where I think it starts to get a little bit challenging because to get a positive return in equities you really need to think about starting valuations and then how earnings and other macro factors including the uncertainties play out. Right now the initial condition, which is valuations, is not so favorable, and that's why I think that's something investors have to keep in mind.
Yeah, you mentioned earnings, and somebody was making this point recently, Vetri, about how while the optical earnings growth has looked pretty strong, dig a little bit deeper, and even if free cash flow has looked okay, operating cash flow has been amiss in a bunch of sectors. And because the optical P multiple or some points above the average standard deviations as well, means that the near term could be a bit skittish. Would that be a fair assessment?
Well, I think that's a perfect assessment of it. Look, where I come from, very old school. When valuations are rich, the market's ability to handle new developments, things it has not priced in, becomes difficult. When valuations are cheap, stocks are far more capable of absorbing, adversity, far more capable of absorbing setbacks, which become difficult when valuations are rich. So, when people ask me what's the biggest risk, I always say the biggest risks are things that I don't know about. And when I look back at the last 20 years, the biggest risks have always been things I didn't know about, whether it was the GFC, whether it was the pandemic. But if there was something which could prepare you for adverse risk, it's always been valuations. So, that's where I would sort of tend to point to in terms of, this risk being something that investors should be concerned about.
Hmm. So, Petri, most smart money that I'm talking to is concerned about some of these aspects. I'm trying to understand what could be the antidote to this, or what could be the reason, or what could be the reasons why the market may still do well if it does, despite these very valid concerns that you pointed out.
Well, my question to you would be, Neeraj, what do we want? If we are on looking at the equity markets as a source of wealth creation over a medium to long term to enable people to achieve their financial goals, then let's be clear. This is not a Ponzi scheme. This is not a Ponzi scheme in which, the outcomes are determined by did the market go up this year or not. If that's the game you're in, then you're a trader. I'm not looking at that. I'm looking at what could be the outcomes for a investor looking to create wealth with a time horizon of at least 5 7. And honestly, I think more and more people need to think about this as a 15-20 year outcome. When you look at it from that perspective, how does it matter? Maybe a rich market can go up. And to answer your question very bluntly, when I look at past history, 1 year outcomes on a rich market, there's actually a fairly decent probability that you still get a good return. But when you drag forward the 3 year, 5 year, 7 year outcomes, you will see that those initial valuations eventually ended up becoming a drag. So I would, essentially answer your question by saying the 1 year outcome is not relevant. What you need to worry about is the drag that can be created on your returns simply because current valuations are high. Now, that is not to say you back away from systematic investment because that's aligned with a long-term outcome. But you need to go back and look at your portfolio relative to what your targeted asset allocation is, and then see whether there is an imbalance which could be corrected.
Very valid point. There's a thought emanating, Vetri, that arguably in a really long time, we are now past the TINA factor for equities, and there are alternatives, fixed income in India, maybe US tech, maybe gold, which has done exceptionally well currently. And therefore, an investor should actually be happy that equities is not the only spot of investment avenue available. What are your thoughts?
A very good point. And to put it in that same framework, what we've been saying is it's time to shift your attention from Tina to Tara. And that's not what it means. What it means is to shift from there is no alternative to there are reasonable alternatives, right? And when you say there are reasonable alternatives, I think clearly fixed income is something which pops up over there. We've now got the sovereign trading at close to, somewhere in that 7 quarter, 7.5 range. We've had 6 years of flexible inflation targeting. Average inflation has been around, 5 quarter during this period. You've got a central bank governor who's saying our longer term target is to keep inflation at 4%, not just that 4 plus or minus 2%. And you've got a government with fiscal policy demonstrating an intent to support the RBI and the MPC in achieving that objective. Now, when you put all of this together, my question to investors would be how can you afford to ignore fixed income and bonds when you're getting 7.5% with all these supportive factors in place? So I think clearly there is an opportunity in fixed income, which is looking attractive today. And you also mentioned other asset classes, including perhaps something like gold. Um, some of our internal work, including what we do in a multi-asset fund that we run, suggests that gold relative to Indian equities, right? So we are looking INR gold versus the Nifty is still placed in reasonably attractive territory. So there is a case for that as well.
Oh, interesting. Okay. I love the caption from Tina to Tara. That's the headline for our story on your conversation, Vetri. Okay, now let me try and get this. So great. So there are multiple avenues for investing, but equity still remains. So my question to you is, after a banner year for volatile stocks, wherein short-term themes have come up, flared up, given multiple years returns in 6 months, 9 months, as the case may be, what do you think is the most likely outcome for themes for 2023? What could do well? What could relatively underperform?
So, first of all, Neeraj, I'm not in the business of forecasting. I don't claim to have the ability to forecast. My own sort of investing philosophy and the process that we use is that the best opportunities eventually show up in areas where there is earnings pressures, cash flow pressures, and where stocks have started to derate. Now, when I look at that in the Indian context, and you could even take this out to a larger template and apply it in that sense, is that this pain has largely now been reflected in companies and businesses, sectors, which tend to be more globally facing rather than domestically driven. So when I go looking for where are the opportunities where profits have suffered, and also valuations have derated, it typically drags me towards things like IT, it drags me towards things like commodities, businesses which are facing Europe, businesses which are facing China, because these are the pain points that are the topic of discussion today. And it's in those pain points will you actually find the opportunities where valuations have become cheap. So, that's the way I'm attuned to think about it. Now, will that necessarily mean that those stocks will perform in the next 3 to 6 months? That's forecasting. I don't know. But typically, if you've lined up the valuations and the pain, it tends to work in your favor over the medium to long term.
Well, I'm just trying to understand. So, if And because that may have worked beautifully for you, I'm still trying to understand, would you space out your purchases in some of these attractive looking names, as the case may be, because of the very fact that the next 3 to 6 months seem a lot more, or actually every 6 months have seemed uncertain, but the next 6 months seem uncertain.
No, I think so. Yeah. I mean, to be very fair, I'm glad you asked that question. Yeah, I think there is a case to sort of space it out. All I'm saying is that these are the companies where you're starting to see the valuations get a lot more attractive. And including in some of these commodity businesses, you've actually got companies with balance sheets much, much stronger than where they used to be prior to this cycle. So to my mind, that's where the opportunity is. But you're right, the window is sort of maybe wider. And therefore, you can use your time to buy into this. But this is where I think the surprises can come. Very honestly, Neeraj, a lot of the domestic structural growth stories, to my mind, have already been priced quite aggressively. And that is why, I would tend to, look for opportunities in these businesses which are more external facing, where, as I said, the pain and the valuations today give me comfort.
Great. Now, because of the answers that you've given me, I'm tempted to ask this to you, Vetri. There are how do I say? There are a few domestic-oriented themes which, in the last 6 months, read PSU banks, read defense, hey, read railways, what have you, which the market believes can do no wrong. I mean, no sectors left to give pain to PSU banks, but we know that they are classic cyclicals. Defense, the story of offsetting, etc., has played out multiple times in the past, but based on order book, they are being priced to perfection and beyond, or for the matter, railways, right? Many a false starts, though this time around could be different. My question is, would you be, uh, would you believe that in any of these themes, this time around does really seem different, or would you rather wait for uh, the proof of earnings delivery slightly more consistently and be comfortable to buy them even more expensive? How are you thinking about it?
Sure. So, I think we must be cognizant of one issue, and which is that I think the events of 2020 and the way geopolitics is sort of evolving, I think the Indian government's call to sort of increasingly drive defense spending through the domestic industry is something which has a very long tailwind. But
Okay.
having said that, Neeraj, unfortunately, I have a long memory, and I'll take you back all the way to 1999, where the most prescient forecast ever made in my lifetime was made by McKinsey about the IT sector, right? But if you actually chase that theme in 99, 2000, you would have had many years of regret to follow after that. So I think there is meat in the defense sort of pivot towards more and more domestic production, but there's no point in chasing a theme when it is overvalued. And we've seen this even in the last 2 years, right? I mean, go back a little more than 15 months, it seemed like IT could do no wrong in India, and then see how painful it's been since then. So, I'm always somebody where I say, the narratives are fine, but if the numbers and the data in terms of valuations don't support it, then you can stay on the sidelines. Now, you may choose to retain some core exposure, but you don't pile into it when the news flow is positive and the valuations already reflect, sort of blue sky scenarios.
Got it. Last couple of questions, Vetri. One is, because you mentioned IT twice now, I'm inclined to ask this to you. I did a conversation with two, not necessarily mid cap, but non-nifty IT companies, Persistent, Emphasis, and both of them on a panel, and they were talking about how they believe that companies which have a slightly differentiated business model than the simple execution outsource story, are not still seeing any conversations with clients about a slowdown. If anything, the employee cost pressures might actually ebb in 2023, which might act as a tailwind. However, I also take cognizance of the fact that there are some sell side analysts who pointed out that in the past such cycles, it is not an earnings degrowth, but a valuation correction, which has led to an issue in IT stocks. But I hear you say that you are inclined to look at IT currently. Now, please tell us how you are thinking about this issue.
So first of all, Neeraj, that was a good interview you did. I must say I watched it as well, so that was a
Okay.
good one. And no, I think there are two ways to look at this, right? See, the larger companies still have a problem that there is a part of their business which is degrowing, right? So they've got some growth vectors, but they've also got some parts of their businesses which are in decline. So when you see their growth outcomes, it reflects these two conflicting, sort of vectors that they are currently experiencing. Some of the smaller companies don't have that much of a legacy business, and that is what creates this slight differential in terms of a growth rate. Having said that, Neeraj, to me, the latter point that you said in terms of valuations is what I think is most critical. Go back to where these stocks were trading in, the last quarter of 21 and where they are today. There's been a significant derating which has happened in terms of valuations, and that is where I start to take a lot more comfort when I look at this sector. The second part is, you're right, some of the cost levers are coming back within their control, but I think we need to be cautious when we think about that. The reason the cost levers are coming back in control, I suspect somewhere along the food chain, it's an impact of the lower demand that is also now, visible, and maybe the demand for talent is not as aggressive as it used to be. So this is correlated to some concerns about demand, but incrementally, simply because of valuations, we would tend to look more positively towards this. And finally, I think, the longer term reason why I think IT is very well placed is through this pandemic. I am sensing that businesses in general are certainly ramping up their spending. Uh, the global customer base has become a lot more comfortable with projects being driven offshore. And these are two structural levers that will, I think, really benefit the Indian IT outsourcing industry over the next few years. So, incrementally, this is a time to look at the sector through all the bad news. Today, Amazon talking about laying off 17,000 people as reported in WSJ. But, it's as this news gets adverse and valuations derate that I think you start to find opportunities.
So businesses, including yours, are ramping up spending on IT.
Across the board. I mean, you talk to any bank, you talk to any AMC, and they'll all tell you that their biggest spend is going into IT, and it's non-negotiable because IT is no longer something that runs the enterprise. IT has become the interface with the customer, right? So all of this is completely changing the way tech spends are happening. And when we talk to banks, Neeraj, one of the things that we see today is that the smaller institutions are actually facing a challenge that they can't spend at the scale as the larger institutions. So, but again, this is, I think, something which is impacting all businesses.
True. My final question, Vetri, and that is on the much touted beeline that the world will make for India when it comes to setting up manufacturing capex. Now, everybody seems to be sold on that story. We've heard some announcements in 2022. A bunch of global brokers say that 2023 will be that page-turning year of sorts when you look at global investments coming into India, FDI, manufacturing. What is your thought on manufacturing as a space and the beneficiaries, ancillaries, etc., that may benefit as a result of that spend if it does come?
So, Neeraj, I think, look, from a hope and from a strategy point of view, I pray that India will be successful this time around in terms of creating the manufacturing jobs that we need to transition people from low productive, jobs that they are in, be it in construction, be it in agriculture, and that's the long-term strategy India needs to aspire to. But it's not as simple as people make it out to be. Just look around you. You look at the US, they've got what they call the Inflation Reduction Act, which is a nice looking title, except when you break it down and start looking at what they're actually doing exactly what every other large country is trying to do today, which is bringing manufacturing back within their own borders and particularly providing large subsidies for what we think are the new areas where growth is likely to happen, be it energy, be it EVs, so on and so forth, right? Climate related technologies. So every country around the world is trying to do the same thing. They're trying to incentivize it. I was reading about Korea, where they're talking about, if the US is giving a subsidy to chip making facilities, we need to do the same in Korea to remain competitive. So I think it's not so simple as saying China plus one, India is the beneficiary. I don't need to repeat this. People have already looked at the data. There are other countries in Asia which have actually already seen a boom, right? We are still talking about when will it reach our shores. And meanwhile, when you look at earnings calls being done by US companies, you'll find that they are talking as much about nearshoring or bringing manufacturing back within their borders as they are about talking about de-risking from China. So I think manufacturing in India is a long-term strategy. I hope and pray it will be successful over a 5 to 10 years period. But I don't see this as something which is a quick fix over the next 6 months or 1 year, simply because you have a PLI scheme, right? Even the PLI scheme is a 5 year scheme in which you're spending 40,000 crores a year. Remember, this is a $3 trillion economy, right? In a $3 trillion economy, your investment rate is 25% of GDP, $750 billion, right? Now you look at that number of 40,000 crores, that's $5 billion. It doesn't move the needle. Should we do it? Of course, we should do it. But it's a small number. Every small step will hopefully take us forward. But I don't think manufacturing turns the needle in the next 6 to 12 months. I think that's a longer term strategy that India is, sort of trying to make a dent in this time around.
Lovely talking to you, Vetri. And that the first week of every calendar, never mind what the previous conversations have been, we should have a conversation with you. So looking forward to that as well. But thank you so much for talking today.
Always a delight, Neeraj. Thank you so much.
And viewers, thanks for tuning into this edition of The Talking Point.